Welcome, everyone, to the inaugural Deep Qcast. Very excited to kick this off. This is my first time not only being on a podcast, but hosting, nevertheless. So try to keep this entertaining and engaging. Can't imagine it being any more entertaining than with two of my favorite crypto specialists, Matt Reed and Carlos Zendejas, who are co-founders of DeepQ Digital. And very plugged into the cryptocurrency markets. Yeah, could not quite galaxy, but future aspirations nonetheless. The Freudian slip, I have to say. Guys, I was super pumped when you reached out and asked me to get involved in this. I know that you guys are very plugged in. You have a lot of things that you wanted to discuss on the show today. As a quick intro for the audience, everyone listening in, my name is Robert Ridzak. I am a advisor for DeepQ Digital, helping them out with a wide remit of different functions as they grow their business. I have with me, again on the line, Carlos Zendejas and Matt Reed. I thought that I'd let them make a quick introduction of themselves, some of their background. Also, it is, just for everyone out there, it is about 4:15 p.m. on a Friday, so we have a couple of beverages in hand. The one that I'm drinking today is Heineken Light. Usually I'm a spirit drinker. I was thinking about doing a tequila, but I haven't hit the gym yet this morning, and trying to do that afterwards. So tequila and weights don't seem to work very well for me. So yeah. With that, I'll hand it over to Carlos.
You've got a kid, so you've got to get the tequilas in whilst you can.
Yeah. Also, you might see darker circles under my eyes. I just had twin boys born about 2 weeks ago, so the beer is gonna hit me a little harder today, I think, than it might otherwise. Carlos, why don't you do a quick intro to yourself and a little bit more about the inspiration for launching this podcast?
Yeah, thanks, man. I also just joined the new dad club. So Rob had his twins about a week and a half ago now.
Yeah. 2 weeks, 14 days now. Yeah.
Yeah, we had our second little baby girl about a week ago. So I'm also getting very little sleep and very much enjoying this beer as a result. But yeah, we're really excited to be here. We're really excited to have this conversation. I think our real inspiration for starting this podcast was, I guess, twofold. The first is, I think if you see in sports today, there's a really cool thing where active athletes are hosting podcasts to talk about their sport. Whereas previously it used to be retired athletes only or members of the media. I think it's really cool that podcasting opens up the opportunity for people to be practitioners in their space and then also have the ability to provide some active color and some insights into what's happening in the market. So for us, we are active participants in the market. Matt and I come from a tradFi market making background. We've both run top 5 franchises for, I come from the FX world, and Matt comes from U.S. Treasuries. And we made the jump into crypto, and we're, I think in May, yeah. I think there's and in the process, there's all sorts of learnings that we've happened. I think it's very similar to tradFi, but it's also a whole new fucking ball game. And we just wanted to go out and have an opportunity to share a little bit more, the things that we've learned, the insights that we've gained along the way. I was looking back on it. We were founded basically the day that Three Arrows Capital went under. And we've also lived through FTX now. So in my decade long being an electronic market maker on Wall Street, I saw a handful of what I'd call Two Sigma events, and it seems like we're seeing them every couple days here in crypto. So it's definitely a fun time for us. So that's really kind of the genesis for what we wanted to accomplish. This was really just to sort of give people an insight in terms of actual market practitioners and demystify a little bit about what's happening. I think there's a lot of people out there who have podcasts or YouTube channels or whatever, but they don't really have much skin in the game. and there's a lot of good material out there, but there's also a lot of garbage.
So, as Carlos said, we started in May. Prior to that, I was at Deutsche Bank for the past 8-9 years. It's actually where I met Carlos. He was a FX e-desk, and I was on the US Treasury's e-desk, and we started doing like meetups and things there, and that transpired into us then starting a company together. We've got a lot of experience in those separate markets, and we now are trying to combine the best of both into this new venture that we have.
Okay, I'm looking forward to picking your brain, Matt. Looking forward to it. Yeah, I know we have a lot to discuss. There has been no lack of news and activity happening in the markets. It's crypto obviously is synonymous with volatility. It's been a wild 12 months, especially over the past 7. A lot of firms, golden children, institutions like FTX have gone under. It's surprised a lot of people. It has been kind of a no-brainer for others. People said they saw it coming. Some people were completely blindsided by it. It kind of is reshaken some of the people's faith in the long-term viability of cryptocurrencies. One of the topics I know we want to talk about today was crypto pragmatism versus crypto missionaries. And kind of just talking about a little bit of a higher level, I think, before we go into more market discussions, but philosophical discussion on where crypto is going to be heading. Will we still see tokens like Bitcoin and Ethereum become world reserve currencies? And if so, what kind of time frame are we talking about?
Yeah, so I think. I'm not sure if I invented it or made it up out of my ass or whatever, but I invented a term, for lack of a better word, called crypto pragmatism. And that's because every time in the last year I've had conversations with buddies about crypto, they're like, "Oh, are you one of these crazy, crypto people that believe it's going to take over the world and that, it's going to become the world currency and get rid of the dollar and we're going to all live in this sort of crypto utopia where we pay each other in Bitcoin and all that sort of stuff." And, I think if anything that I've learned over the past, few months is that if you go onto Twitter and you listen to the crypto missionaries that preach this gospel of crypto, and then you make trades based on these narratives that people place around crypto, you're just inviting yourself to lose a shitload of money. So from our perspective, I won't speak for Matt, but I got into crypto because I believed a lot in sort of that missionary view of the world, right? That crypto was going to save the world and it was going to be this fantastic thing. And, it's great to have sound money and sort of all those libertarian principles. I was like, wow, that's, that resonates with me. I think this is probably a general good thing for society. And I think what I learned getting very much involved in crypto, I always make the analogy that it's sort of like if you're a trained boxer and then you show up to a bar and get into a bar fight and then you get really disillusioned that someone smacks you over the head with a fucking beer bottle. It's that's sort of my baptism into crypto, where it's guys, hold on, this isn't boxing. We were used to living by a certain set of principles in the tradfi world, and then you show up to crypto and you're like, yeah, that just doesn't exist anymore. It's kind of like the wild, wild west. And so for me, I've had to sort of reconcile what I thought were these sort of very lofty philosophical ideas, and really kind of say, all right, well, it's important for me to be pragmatic about how this is viewed and to understand the data behind how this thing trades and understand the incentive structures about how everything works. And then when you do that, you can still believe that in the long term, crypto is going to be fantastic. And maybe over the longer term, we get to this point where we live in this crypto utopia. But in the near term, we've really got an emerging technology and it trades like a risk asset. And there's a number of different characteristics about it, but you kind of need to come in with, eyes wide open to really understand exactly what the dynamics that are leading it right now are, because that's how you make money versus lose a lot of money in the market. I don't know, Matt, what are your thoughts?
Yeah, I mean, as a tool for the transfer of ownership for the blockchain, it's an incredible piece of software. I don't think that's going to change. Definitely, how it's traded and how new that market is. So, like we have various exchanges. We were talking about this earlier today, but the liquidity profile of the things that trade, like Bitcoin, US dollar, are actually pretty reasonable, given where we were like 2 to 3 years ago. So there is like pretty good liquidity if you even over the last couple of weeks. Even if you want to trade Bitcoin US dollar, there was still liquidity to do that, and that wasn't the case a few years ago. So I think that from an exchange traded product, I don't mean like an ETF, I mean like over an exchange, there's actually a fair amount of liquidity, and it's going in the right direction for it to be more stable for traders of risk asset. Whereas before it's kind of very illiquid. As soon as people pull back, you're stuck with something that you can't trade.
Yeah. Do you think that it's fair to say that, I guess if you were to guess how crypto scales in the next, I don't know, 12 to 24 months, like who's coming in, who's adopting it, what's it being used for? What's the utility of cryptocurrency?
The utility is, it's not quite there yet. And I think everyone knows this. Right now, people will use it for fiat into crypto. So people will generally go via a centralized exchange. And then there are applications in DeFi which are still very new, right? But there's a whole lot of scope for that to develop. I personally think a lot of that will be more regulated. There's some very interesting things that people are doing, but there's no way you would be able to do that under the current regimes in the US for indefinitely. Like you can trade options and all sorts of stuff on top of this, and it's completely not regulated. But the ability to financially engineer a contract into a piece of code is very exciting. I think there are some companies out there that are trying to make that more accessible to kind of the tradfi space to enable them to use blockchain technology. I mean, we know a couple of the guys, but like one of them, Axoni, are trying to allow the blockchain to be used to transfer data between those banks, which is a very interesting concept. So I think the blockchain technology is going to take off, and then for crypto itself, it's there's clearly a lot of cryptocurrencies. Is there going to be just one or many? Like that's an open question. But the ones that will live will have the most utility in the biggest user bases, which are currently like Ethereum and Bitcoin.
Yeah, no, I tend to agree. I often like tell people, especially like my non-finance friends who ask me about, what's going to happen in this world. My primary thesis is really like focus on layer ones, right? Like we're currently building the tracks, and you can't really invest in the rail cars until the tracks are built. So, when I think about from my personal perspective, like what's really going to move the needle in the next little bit? Well, it's going to be, advancements. I mean, I think Bitcoin's always going to be around. I think there's a very solid use case for, Bitcoin being digital gold, solid money, whatever you want to call it, right?
I think Dorsey's trying to build that block app or something that was going to be purely on Bitcoin, like a specialized wallet. That could take off pretty.
Did you ever read that white paper?
Yeah, I think.
But that no.
It's a lengthy one. Sorry, go ahead.
No, but I think other than that, really, you're dealing with people like Ethereum, which have recently had the merge. We have all sorts of like really great technological advances that are allowing applications to get built on top of it. But exactly where that ends up, like we don't know right now. Like it's still kind of an emerging technology. The utility is sort of like whatever you decide it can be, and in some ways that's actually really exciting and leads to fantastic growth. I remember back in like 2010 when I was trying to like start a company in B school, we were out raising money and we had two options. And like we've been told, listen, if you want to raise money in New York, you have to have actual revenue, and all the guys there are going to value it like it's finance. But if you want to go raise real money, you go out to San Francisco. You pretend like you've never seen a dime of revenue in your life and sell some grandiose vision. And the delta, and this is like 2010, like VC money. The delta was like, you could raise $2 million in, New York, or you could raise on a $2 million valuation in New York and a $6 million valuation in San Francisco. And the only secret is that VCs in San Francisco just did not want to hear about your actual utility and revenue plan. So I think in some ways, the lack of utility in crypto really helps the story. So it's it could be anything. We could make these fantastical NFTs. We could change the way that artists are paid and compensated. We could change the way that the financial system gets done. And it's awesome, cool. And then once you start to narrow down the eventualities of things that actually can happen with the technology, people actually start to put numbers behind it. And then that's when shit gets real.
Yeah. It's interesting you say that about what you can actually do with the technology, because I keep on coming to the idea, you look at internet and the explosion and the use of internet, and it really, mobile phones like the iPhone really changed how we leverage the internet, and that really created, it was like the internet was with us 24 hours a day, seven days a week. And you talk about these these interesting new ways to leverage crypto and Bitcoin and NFTs, digital asset ownership. But at the end of the day, you need underlying infrastructure to be able to use those things. And I think that really ties into your thesis around layer ones. It's that technology is still being built out, and that's really where that needs to be down pat before you can really see an explosion in other areas. Would you agree?
Oh, for sure. No, 1,000%. I think about the analogy of, YouTube? Do you think YouTube were the first people on the planet to think about putting videos on the internet? No, they executed well on an idea, but they happened to get lucky at a time when broadband internet became readily accessible. And there's other technological factors about compression and hardware and all that sort of stuff that went into it. But a lot of times the idea is less important than the confluence of all the infrastructure that needs to get put into place in order to make that happen. And I think that we're still at a place right now where that infrastructure is getting built, and it's really cool and there's lots of possibilities. But we're not anywhere near to the point where we can handle throughput to really manage a global network of transactions over a blockchain, in a way that satisfies both security and, sufficient decentralization, which is a whole different, another, honeypot to kick over, but, it's where we are.
Yeah. I guess to that point, then, you're talking about these, what we've been just talking about is just over blockchains, so more on-chain infrastructure and utility. But that leads into a question I had, was around centralization. Do you guys think centralization is bad? And could it be useful as a bridge to greater decentralization?
I think you have to have it as a bridge. Because how else will people convert into crypto in the first place? It's not like fiat's going to just disappear. So I think there does need to be some form of it. And that, to be honest, is where we see a role to play, especially for our business. We want to try and make those markets more accessible and be able to help clients with that kind of flow ultimately. So I think you will need to have, and I think the growth of bilateral transactions will be on the rise as well. So we talk about centralized exchanges, but to some extent you can transfer directly cash or crypto between me and Carlos on the side. And we can decide how to do that, but it will probably involve some kind of fiat, and then something on-chain, and then something fiat as well, which would go through the centralized system. So I think there will definitely be a role for centralization. Like we've seen, I don't know if you want to talk about FTX stuff now, but
yeah,
you can see
how
it can go wrong, right? But I think that's just a lot of fail safes that should have been in place that kind of weren't there. It doesn't mean the concept's bad. The classic case of not your if not your keys, not your money, or not your crypto. It's like the one rule to learn from that. And I think that's where the market will have to go in order for people to be happy to do this. Is as long as you actually have custody and you have your own keys and it's yours, then I think people will trust the centralization process. Because I don't think anyone really minds that much about being ID'd. Like, if you're a above board member of society, then all your transactions are monitored as they are today.
Yeah.
So I can certainly see that integration not being a huge issue, but there will definitely need to be centralization.
Yeah, because I always think about like this concept. Everyone's like, "Oh, like what do you need a bank for? Like you can be your own bank with crypto." Well, how many people actually want to be their own bank, right? Like seriously, like if you've tried to custody your own, keys before, you've got to set up, complicated hardware. You've got to set up a wallet on your computer, right? It's not like there's like a very well defined or easy way that like my parents back in Nebraska could set up a Bitcoin wallet and safely keep it on their phones. Like there's just bound to be lots of people that just end up losing it because they're technically unable to like manage that themselves. So I think like centralization plays a huge role just in terms of usability and adoption. And there will be better tools, but like I just literally don't view a world where people outside of like very hardcore crypto guys and very hardcore technologists literally want to manage or be responsible for maintaining their entire life savings, on a little hardware wallet or something like that. And I want people to be able to do that. I think that's really important. Like, if that's what you want to do, great. But I think like there's a role for trusted, centralized, or DeFi parties really, but just like to have like a really good user experience. Yeah. In my view, I think that, I actually think that FTX is kind of pushing things towards like two edges of the spectrum, right? Because like FTX fits in this world where you basically get these 20-something MIT guys that are just like speed playing through every possible fucking mistake that's been made in traditional finance over the last century. And like as a result, bad things happen, right? And you set up an entity in a little regulated jurisdiction, you kind of like get market share by doing things that other exchanges and other places just wouldn't or couldn't do from the regulator's perspective. And you get a lot of market share and you grow very fast, and then all of a sudden people wonder why their money disappears. So I think that like there is an actual like well-defined role for people that are experienced in financial markets and understand regulation, understand technology, understand custody, counterparty risk, all that sort of stuff. Like, let's not throw the baby out with the bathwater because we have this like new technology that's cool. So I think like we actually do ourselves a disservice, and I think this is true in like literally everything, not just regulation and stuff. Like as a fun for instance, right? I remember having a conversation early when I'm sort of like talking to people and getting a sense for crypto, talking to this young PhD who was putting together this white paper talking about how you could create a delta neutral AMM market making strategy that earned all sorts of P&L and was like constantly hedged. And he's like, oh yeah, well, all you have to do is make this assumption that returns of all assets are normally returned, and then you get this really nice stochastic calculus result, and bingo bango, boom, delta hedge portfolio. It was like, cool. I would like for you to go read a book called When Genius Failed.
Long-term capital, mate.
Yeah, it's like this literally blew up the market in like the late 80s and caused like a sovereign debt crisis. Like, so there is value to having some old dogs out there who have seen some stuff and read some books and all that sort of stuff. Because I think that we have a problem with bad actors and inexperienced actors. Although I don't think SBF was inexperienced, I think he was just a bad actor who's trying to act like he didn't know what was going on. Point being, though, is you just need people that know what they're doing, and there's a little value to centralization. There's actually a little value to regulation. There's a little value to, having people who have experience doing this in a traditional world, but yet who are also open to sort of a more inclusive, technology-oriented, perspective when it comes to crypto.
Yeah, I mean, the regulation part's interesting. Like, okay. Because, especially in the US, it's not really clear how that's going to play out. Like, I'm curious, at least in the FX space, Carter. So, what are your main regulators, or because FX and crypto are probably the most similar things to date, right, in terms of asset class. I could talk about Treasury with FINRA and the SEC and everything, but it's not quite that direction yet. At least the SEC haven't grabbed it. What kind of were the rules of the road for trading? What agreements, what regulators were in place?
So I think FX is an interesting model because you're right. There's no one global governing entity that really guides it. So, you do have the SEC, you've got the CFTC, you've got the Financial Services Board in London, and I mean, a number of global regulators almost have to collaborate to get things done. Versus, I think in like other markets, for example, like U.S. Treasuries and U.S. equities, like the SEC is the law of the land, right? They say something, then that's it. And the way that U.S. persons laws are dictated in the banking world, basically, like, regardless of whether you're a foreign entity or you have a foreign, subsidiary or something along those lines, it's like if you have ever once thought about thinking about someone who has been in the U.S. one time, all of a sudden now you're under the purview of the, SEC. So I think what ends up happening is that the market in FX tended to evolve as sort of a collaboration across multiple entities, and the interbank market tended to put together what I would call like industry best practices, and I think it's like no one wants to believe that like anything can really be self-governing, but to the extent that they can, there is, for example, like a global code of conduct that all major FX broker dealers have signed, and they've got these like universally accepted best practices in terms of like what's ethical, what's allowed, and they stick to them and they cover them, and it's a huge marketing and selling point in the market. If you're BlackRock or Vanguard or one of these like very large asset managers and you're choosing your counterparty, right? Like people get held accountable to how well they stick to it. So I think it's interesting because it still is subject to regulation, but it's also subject just as much to market forces. And, I think unless like the SEC makes this massive land grab and kind of like puts everything under its own purview, which I think it might be too late to do, just given how much activity goes on offshore, it might have to live in a world where it decides that it's going to play ball with, the global community rather than just sort of saying, all right, we've decided it, our word is law, that's the end of story.
So what kind of rules are there then? Like, so, for instance, in the securities world, everything's reported. So all transactions you do, whether they're over the counter or on exchange, will be reported to the Fed. So what kind of parallels are there in FX? Are there any? Like, or is it more just like spoofing and market forces that you're talking about?
Yeah, so the rules are really primarily built around things like spoofing, market rules, whether or not you front run client orders. I think in the FX market, everything is bilateral, right? So you don't have to trade on an exchange. So if I'm Carlos and I'm trading with Matt, then I trade with you, and every trade that I do with you, rather than facing some exchange as an intermediary, I know exactly that I'm trading with Matt. So if I see that you're going out into the market while I am like actively dealing, and you're doing something shitty, like you're front running all my flow and eroding away my alpha, then I can go to you like, Matt, what are you doing? Like, I can choose not to deal with you, and I can take you out. Which is why I think, like, the concept of being able to have bilateral trading arrangements in FX, where you deal with a trusted counterparty, and rather than it being anonymous, I know exactly who I'm dealing with on the other end, allows me to be able to hold my counterparties accountable for their market actions. So it's kind of trade-offs where, there's no rule that it has to be reported, so you lose a little transparency. And that may or may not be a good thing, depending on what you want. But the benefit is that if you're a large market participant, transparency isn't really all it's cut out to be. Like, you don't really, if I'm dealing 100 million, and after the first million, that gets reported to, the SEC and then publicly available, well, then the market knows that I've got 99 left to do. And that really sucks for me.
You're right. The time at which that information is released is critical. So there are usually delays built in, but it's also one where, like, a large bank doesn't want to. Why would JP Morgan want to give away that information? Like, they're a big part of the market share.
And even on a day, even let's say you like do it by a day, like, they still don't want that information out there. No one benefits from having it, released even at a future time.
Well, except I think the Munis is probably the one differential example where all that data is there, and therefore anyone can build a Muni model, which is quite interesting because they all have to be reported. So your barrier to entry is kind of low.
No, but I think, and that's also sort of another, differentiator, which is, and once again, this is all trade-offs, right? If you think about it, in a world where everything trades bilaterally, meaning I trade directly with my counterparty, there's no middleman, and unless one of those counterparties tells the market, no one knows that trade happened. There then becomes an edge by being one of the big guys in the market, because you now suddenly see the market and you know what's going on. The benefit to that, though, is that, if you're responsible as a market maker, then your clients can deal with you and know that they're not really going to move the market dramatically. And if you do move the market dramatically, they'll know who did it because they know who they traded with.
Yeah, exactly.
The flip side, on the other hand, and this is just, I'm very biased because I come from an FX background. The flip side is that if you trade on an exchange, well, everything's collateralized fully. Everything is very transparent. But then what you have to worry about is, information that you do gets completely telegraphed to the market immediately. And those that have a technological advantage, meaning they have, co-located servers next to the exchange, they've got very optimized code, they've kind of dedicated the resources to be able to have that informational advantage. Well, they're effectively now a tax on the system. They're not providing any real liquidity. They're literally just sort of like swiping back and forth between exchanges and nicking out arbitrages. And I think that's good to a degree, but at the same time, it's also, it is a tax, and it makes it very difficult to deal in the market.
Yeah, I was trying to think devil's advocate, or what's the benefit of like a HFT ARB strategy? From like a regulator's point of view, is it kind of does bring some price stability. So like someone in California would end up paying the same as someone in New York, for instance. Whereas without that, then people in different locations would generally pay different prices.
For sure. I think you're bang on. Like, you need to have some element of that for price discovery, right? Yeah. Otherwise, we don't really know what the price is.
But at the same time, it's like crossing spreads in and out isn't going to add value to the market per se, because it would already be at those levels anyway. So you're just taking advantage of a spread to close out. So
I think ultimately, this is one of the things that, like, I always thought about FTX even before we found out they were a fraud. Just sort of like, if you have a venue like FTX and you know that they have a high frequency trading firm, Alameda Research, that they co-own, like, let's just forget about the commingled assets, which is objectively bad, but we didn't know that was happening. Yeah. Anyone in the market knew that if you traded on FTX, that Alameda Research was basically using that information to trade to their advantage. And so, like, I always thought to myself, like, knowing what I know about markets is like, okay, well, why would I want to then trade on FTX? If I felt like I had an edge and I was a professional trader, right? The minute I dealt on FTX through some unethical arrangement between Alameda and, FTX, like, they were literally just scalping my alpha. So
True.
I never felt like that was a very good trade.
No, I think that was one thing. We were going to talk about though as well was the difference between. So like FTX obviously is a new exchange. There's several of them out there. There's Coinbase, Kraken, Gemini. They're kind of like US entities that are, we thought were all really well regulated, including FTX. Or at least they say they are, but that just means they have a license. It doesn't really mean that much. They're a money services business with a stamp to say you can do what you want to do, to like offer flow and take positions from people. And then it sounds like they probably weren't getting the right review that they should be getting or oversight. But how does that really differ from like tradfi exchanges? Like, are they, like, for instance, in Treasury's BrokerTech, for instance, biggest exchange by traded volume, it's actually owned by a subsidiary of banks and other investors.
Yeah.
And actually, I think that's going to happen soon in crypto, right? You were mentioning this the other day. I forget what they're called, CBOE Digital, right?
Yeah. SIBO.
So there's, what was it?
SIBO, but it's Chicago Board of Options and something or other. I forget, but everyone just calls them SIBO. They own an FX, what's called ECN, or Electronic Communications Network, called Hotspot, or that was formerly Hotspot. They're like one of the largest venues, in the FX world. I think they do something along the lines of like 10 to 20% of FX volume is done on that network.
Yeah, I think you've mentioned when we've been chatting about this. This is interesting because, like, the spreads that BrokerTech, for instance, would make, fees wise, would not put them in contention to be valued at the same amount that FTX or other such crypto exchanges were marked at from their VC raises. So, do you think that's partly what played into some of this? Is the expectation to meet demand from investors of massively overvalued business models?
1,000%, right? I think one of the things that always shocks me, and you nailed it, was that, like, you add VC P&L expectations to a like crypto exchange, and what you end up with is like this expectation that you're going to hit a 1,000% return and be worth 100 billion. But I mean, as just like a frame of reference for everybody, I used to pay brokerage to Hotspot, right? And the broker and EBS and all these different and they're kind of like these sleepy businesses. They're valued at several $1 million, not several $1 billion. And we'd measure our spreads and our fees in what's called dollars per million. So obviously in finance, you've got the percent, which is 1 out of 100. You have a basis point, which equals 1 basis point equals 100. 100. So 100 basis points equals 1%, and $100 per million equals 1 basis point. So if I had to go on Coinbase right now, the introductory fees that I would pay to be a market maker, like 0.5%. And if I were to go into the FX world right now and go to SIBO FX and sign up to be one of their like top tier broker dealers, I'd charge anywhere between like $2 a million for like the big guys to like $20 a million for like the really small guys. But it's just an order of magnitude less in mature markets. And so if you think of like crypto,
relatively low risk assets as well, comparatively as well.
Yeah. I mean, but even in like equities, where it's more risky. Like you're still paying a basis point or two, right? Versus massive, fees for crypto. So like one of two things is going to end up needing to happen. The first is Coinbase and these types of guys that have like very large, fees, they're going to have to either tell their investors that the PE and growth expectations going forward are materially, diminished because market forces usually drive down fees and spreads in markets businesses, or they're going to have to go out and engage in riskier and riskier businesses to grow into their multiple. And it's like, do you really want, like, as an investor, you probably maybe think that it's better for them to engage in riskier activities to try and do that. But as like net society, you prefer for an exchange to just be really sleepy. You'd want it to be a utility where they take client flow, they do the thing that they're supposed to do, and they don't fuck with the client flow. End of story. So I think there is a bit of like an incentive structure where they're not put in a situation where they're rewarded for being sleepy and compliant and doing all the right things.
Yeah, and I think that's definitely an area that the regulators would have to have more oversight of potentially.
And to your point, like this is one of the reasons why a lot of like tradfi exchanges are owned by a consortium of banks, because they're like, oh shit, we need this thing, but it's not a very viable business on its own. So let's just all chip in some money, and this facilitates our $1 billion markets business.
Yeah, so let's say that we get the sleepy exchanges. What do you think that's going to mean for like the adoption of crypto and like bringing in the more institutional guys? How do you think this is going to play out going forward, given like FTX and everything that's happened?
Yeah, I think there has to be like a desegmentation of retail platforms and institutional venues, right? Like if I go onto Charles Schwab right now and trade, like I'm not facing, Bridgewater or AQR or, Bank of America, right? Charles Schwab is taking that flow, they're aggregating it, and then they're packaging it up and giving it to broker dealers who then face the market. Because you kind of want like your liquidity distribution and the actual like retail platform to be separate. Like it actually doesn't make sense to have BlackRock trading on the same lit venue as like my uncle in Nebraska. So like in my world, I think that like Coinbase will still be like a really valid thing, but they'll likely not be the primary liquidity venue in the market. They will likely be a place where retail people can go and trade some Bitcoin, custody their Bitcoin, and then have access to other crypto type products. And then ultimately, Coinbase is just going to leverage liquidity providers on the street, for lack of a better term, that can offer real institutional grade liquidity.
And they'll be able to do it at a discount as well, in theory, if they aggregate across many customers all at once. Yeah. So we had an interesting chat about that, about writing individual portfolios, which would then each all get. So, say me and Carlos had our own portfolio of crypto, and then we each independently went and bought whatever weights we came up with. It would actually be more efficient if we pulled them together and had it done at the end of the day, say, or whatever time of the day, because it could be that me and Carlos independently have a completely offsetting trade, and therefore we don't have to pay bid offer in the market. So there's definitely some benefit to having more, even retail guys on the street internalizing before things hit the market.
And I think like this is all, like weirdly, this is all kind of like solved. Like these problems have been encountered, solved, and there are solutions for them out in the market. And so I think that they're like all of these things kind of fall in the category of cool. Well, we solved this problem and now we know how to handle it, and we're going to go out and we're going to use some sense and do the same thing in crypto. Given what we've seen, do you think FTX is an extinction level event for crypto? And if not, what do you think are the implications on the crypto industry at large?
So I don't think it is, and I think the data is kind of telling you that a little bit as well. So if I aggregate some of the trading volumes across like some of the main US exchanges, typically before FTX, you could trade like over one Bitcoin in around a 10-second time interval. Immediately after that, it crushed down to way under half a Bitcoin in a 10-second, even as low as like 0.2 Bitcoin, which really kind of tells you liquidity was starting to dry up across everywhere of the street. I think what we've seen is as the contagion stories continued, and it's almost a month now, right? We're 4 weeks into it. There are still going to be more things that come out. Like we don't know the full depths of Chapter 11 filings. We don't know everything, but I think we've seen a good chunk of that exposure, or at least companies that have exposure, and all that's going to deter is short-term investments. But the liquidity profile is really starting to build up again. So we're kind of now back to that one Bitcoin in 10 seconds again. So I think, at least for now, I mean, of course, another event could make that go down, but at least the traded volume, the appetite for other dealers to trade is there, other market makers. And with liquidity comes good trading opportunities. I think really which is then good for the ecosystem, because the more liquidity is, the more people can transact, and therefore, make money in this system by getting it on or off fiat. Which, even if you work in a DeFi business, you're probably going to want to change some of your crypto that you're making out of it into fiat so you can pay your bills, at least for now. So I think I kind of use that as a view to see how healthy things are. Are there participants there? And it seems that there are. And I think, like I said, it's a very different scenario to where this space was a few years ago. So that's
for sure.
Really good outlook. And then the question is, will that work for larger and larger institutions? I mean, I think there's going to need to be probably a specialized exchange for non-retail, such that going to what we talked about to try and get a more internalized view of flow that can then be dealt with on that exchange, because it's going to be too big for if you were then on that exchange as a retail guy, you'll just get run over every now and then. Like you maybe 10, 100K max is probably going to get wiped out with one institutional guy's trade, and you just get done.
Yeah, I think, and for reference, like you and I started full-time in crypto in May, but this is both of our second or third round trip on the whole crypto mega cycle. So, when we say this is exactly, we're still here, made of diamond hands and just nuts of steel. But I think reality is we've seen this kind of play out before. I agree with you. The last time when we saw the market die down, there was zero liquidity, nothing happened, it ground to a halt. And I think that we still might see some shoes let to drop, right? There's probably going to be a few more lenders that go out.
Yeah, that DCG looks a bit on the ropes. It has a loan out to Genesis as well, so even its own balance sheet is compromised. So I think the Genesis store will be interesting, but even then, the people that invested in that will lose out, but that's not the entire market.
We were just talking about how surprised we are that the market's really held up since FTX. I think for me, one of the interesting things about it is it's kind of held in this range, and I have a working theory that, one, the guys that were manipulating the market the worst, and two, they went out of business, and then two, the people that were lending money to people to short the market are also pretty much out of business. So I think we're at a point right now that unless you have the coins, you can't sell them. And we may have discovered basically the bottom, unless there's some other catastrophic event like Binance going under, Tether going under, people finding out that, Grayscale just doesn't have the fucking assets. But barring some major catastrophic event like that, which I think is like equal to or greater than FTX going under, and we'll no longer call it the FTX debacle, we'll call it the Binance or the Tether debacle. I think I really, I'm not going to say it's the bottom, but I definitely think that we've kind of like realized that this might be a natural sort of like settling point for cryptocurrency. Now, I don't think that we should conflate the bottom with being the road back up. It could trade sideways like this for months and months, but I'm actually very surprised at how well the price has held up. And I think also, one of the things that I've been doing, talking to investors, talking to people that are like really well entrenched in the community, every single one of them that I've asked you is, do you think this is an extinction level event? And most of them say absolutely not. In fact, I still get phone calls on the regular from headhunters that are representing large tradfi firms that are trying to get into crypto. And I think if you've ever worked at a large financial institution before, you'll know it's a very slow moving ship. It's like their decision to get into crypto was made, if they've made it, probably like 3 years ago. And if you think of the legal HR resources that have gone into like scoping out the problem, getting all the requisite things into place, if they've made that decision and they're still here, that's like a really, really, really hard thing to turn around, right?
Yeah, within a 1 month time frame to be like now, it's
like,
probably
nope.
unrealistic.
Yeah, so it's. I think that obviously there is some real possibility that it slows down, that it slows down people's adoption. But in some ways, I think that these large institutional players are just slow-moving ships that aren't going to make their mind up, in a day. And we all have experience working in these large bureaucracies, so it's like this isn't a surprising thing. The one other thing that I will say that's kind of funny is the amount of intense Schadenfreude that exists out there for people that are like, I knew Bitcoin was a fucking scam. This proves me right. So in some ways, I think FTX is almost like headline news on CNN or Fox News or something like that, where all it really does is it sort of polarizes people to their prior. So if you loved Bitcoin previously, your response to FTX, at least in what I've seen, is this is just an attractive buying opportunity. And if you hated Bitcoin before, you're like, I knew this was just a fucking scam. And there might be some independents in between that are really kind of deciding where they want to live in the world. But, a lot of the opinion that I've seen anyway, and talking to people in the industry, is just sort of we already had our polls figured out, and now we've just gravitated more closely to whichever poll we chose prior.
Well, I think it also talks to the institutional adoption of crypto, right? So you have people that play fast and loose, and those people get washed out when there's a massive deleveraging event. And you have folks that are more methodical, very steadfast in their approach. They're the ones who are going to end up itching away. They don't always catch the headlines, but those are the ones who are staying, that are going to probably be able to survive a lot more prudent style market participants.
Yeah, I've never understood for the life of me why anyone would roll into crypto and say to themselves, man, there's this asset with 85% annualized volatility. You know what I want to do? I want to take on 10x leverage. That sounds like a great trade. You've got to be a crazy person. You have to be a full-on psychopath to YOLO like that. Yeah. So, good on that. And honestly, that's you can make a lot of money, but you can also blow up spectacularly that way. And I'd prefer to, get rich a little slower.
Awesome.
So what's up next for us? Are we going to talk about something in the next episode? What's that going to be? I just came for beers, so on the. I thought this was a beer podcast, to be honest.
Exactly. We're going to talk about the deliciousness of Bud Light, which is fantastic. No, I think so. For those that are listening, this is going to be the 10 people that are listening to our inaugural podcast about. I think my mom and my sister are going to be my representation in terms of the listener pool. But I think the goal with this one is just to kind of give an overall sentiment of where we are and what our views and thesis in the market. And in the next episode, I wanted to really get in depth on market microstructure. And I think that whenever anyone hears about like high frequency trading, there's this sort of like mystical view that these guys are doing like really, really, really complex, math and writing this like insane code, and through some like, alchemy, they're able to generate all this sort of, yield. And I wanted to demystify that a little bit. I wanted to talk about the mechanics of it, because I think whether or not you plan on being an HFT trader, if you want to deal in the market and you want to understand like how your information gets treated, it's like really, really, really important to know how these microsecond structures end up getting traded, because how the market gets designed and how it trades actually has a significant impact on your overall ability to maintain your informational edge as an investor. So for me, I think this is like, the more people know about like the ethical and good way to make a market, the better, because it yields to healthier and better markets on the whole. So we're going to kind of start a series where we go into what we'll call market making 101 and discuss some of the trade-offs in terms of, what's legal, what's ethical, and, how does that have an impact on you as an investor?
I'm super excited about that too, because I feel like, especially in conversations that I have with colleagues, people roll up high frequency trading all into the same bucket, and there's a lot of nuances between the various HFT participants and how all of them make money. And I think that being able to create a little more differentiation and be able to distinguish different styles and strategies and approach is going to be super, super interesting. I'm looking forward to the next one.